Guys, welcome to the show.
All right.
So, you're watching this on Sunday, and we usually record it on Fridays because we try to have a life. We do a lot of things on the weekend because the market's closed. But, what was I going to say? I was saying, I'm not even sure what could happen between now and actually when this airs.
Sunday? Who knows?
It's just been a wild ride this week.
Volatility is the name of the game, right? Volatility doesn't mean the market goes down. A lot of people think that the word volatility means the market's going down. No, volatility works in both directions. So we got a huge spike up last week, and so far this week we've given back about half of last week's gains. That's volatility. It moves up and down a lot in both directions.
Yeah, and you can't time it.
No.
You can't time it. A lot of people think that what we do is market timing, and it's not. It's trend trading. It's very different. We just trade with the trend. But when there isn't a trend when there's this much volatility. It just screws up the trend because you can't really tell exactly which way it's going.
That's the beauty of trend lines.
It is.
And the moving average lines.
It helps.
But you have to let it go up and down on a day-to-day, week-to-week, whatever. And as long as it doesn't break the line, then and even when it does, so when the actual trend doesn't change until there's a lower low and then a lower high.
Yep.
And if you really want to confirm it, you wait until it breaks another lower low, right? Nobody wants to take on that percentage moves when we've had these big. We've been going up for 2 years.
Yep. It's hard to swallow, and it's hard to make good decisions when stuff like this is happening. And so you have to – this is when having a plan and having a methodology and having a strategy that you trust and that you are carrying out, right? This is when it is most important. Yeah. If there's only one thing you listen to this whole podcast right now, guys, and gals, is get a plan together, figure out what you're going to do, when you're going to do it, and actually stick to it. Because then this volatility – isn't as bad because you have a plan. It still kind of sucks because you have to watch this play out. But if you have a plan, you have a line in the sand, like Jerry was saying with a trend line, or a moving average, something that tells you, okay, I'm not going to change my position, whether you're in or out right now, right? A lot of people are out because they just don't want to risk it. Sure. A lot of people are just sitting on the sidelines going, let me just let this play out. And that's historically not a good idea this time of year because normally – whatever normal is, this is the time of year when it's going up, and you don't want to just ignore that. So it's very difficult right now to make sound decisions. That's why if you have a plan, you stick to the plan, and it is what it is, and you can readjust later.
Yeah, if you have a gambling mentality, so by that I mean if you're watching your TSP account every day, and you're like, oh, I knew I should have gotten out the day before this, or I knew I should have stayed in the day before that. If that's happening in your mind, you have a gambling mentality with your TSP. And number one, you drive yourself nuts. Number two, you're going to lose on the upside and the downside.
That's the sad part. That's when you get hit both ways because you're always second guessing your decision, and my lines in the sand aren't always the same as Jerry's, right? Even if we follow the same kind of strategies, we have different risk tolerances or whatever, and that's okay. So a lot of times people seem to think that because we have a certain model or a strategy that we use, that we expect them to follow that to the T. And that's not the case. Actually, the only reason we have a model that our subscribers follow is so that they can have some kind of frame of reference. Because if you don't have, if the teacher doesn't show the answer on the board, like math, sometimes you can have different ways of getting to the same answer. You have to got to give people a frame of reference. And so that's what our quote unquote models are about. But there's plenty of different strategies that you can use to get to the same place. You just got to find the one that you understand, it speaks to you, and you're actually going to carry out and use again and again, not change every couple of weeks. We have a lot of people that we know that do that. One day they're basing their strategy on seasonality. The next week or the next month they're doing it on swing trading, and it's like you can't switch like that.
No,
it doesn't work.
If your perspective is always the prior high, it's very hard to get out of the gambling mentality.
Yeah. If there's one thing you do, I said there was one thing earlier. If there's another thing you do, if you feel like you're in that gambling mentality, you got to.
Isn't there a 1-800-GAMBLERS.MA or something like that?
Yeah, I don't think it's for investors though.
FanDuel.
It should be. There should be. We should have some sort of mechanism they can call. But yeah, you got to get out of that mentality. It's not going to serve you well as an investor. All right, man. What do you got for this week?
I'm going to have. We're not going to get to it first, but I'm going to have another most important thing you have to think about. So, okay, TSP. So 17 November 2024. So we'll talk about what happened this week. And we had a holiday, which it seems like it's been an awful long week considering that Monday was actually a holiday. We got a FedSmith post that somebody posted into the group. At least one person, might have been a few people posted this into the group. And it is, in the big scheme of things, something that hopefully you guys will listen to because it's a game changer in terms of the way people think about TSP going forward. And then how investors are, what do they call it? Irrational exuberance, I think. Not Bernanke, who was the chair, not, who was
you got me. I don't know.
Can't remember. Greenspan.
I've heard the term, but I don't know who said it.
And then the 10-year yield, it's the thing that, as far as charts go, in my opinion, is the most important chart. Too many most importance, but there you go, and the TSP fund charts. So Monday, stock market was open, bond market was closed. That threw some people for a loop, like they don't understand why there was no update, and federal government was closed. So TSP didn't update until Tuesday, which got a lot of people all kind of worked up. But it's just what happens. It takes into account on the next open day what happened on the days that was closed. So it's no big deal. They figure it out. Tuesday, you got business optimism. It's small business, really. So small business optimism jumps to 93.7 from 91.5. It was forecast at 91.6, so a pretty big move up. So small businesses are the most optimistic they've been in 2024, and the S&P is down almost a third of a point. So this is the chart of that, and we're basically right back where we were in July, but July was a good month. October, definitely a good month. So if the trend of this keeps going, that's positive, right? It's a sign that the economy, at least the sentiment of small businesses, is getting better, which is a good thing. And then Wednesday, long bonds, so 10-year, 20-year, 30-year bond yields are still going up, even though the Fed is, in this rate cutting cycle. So mortgage rates went up to 6.86% from 6.81% last week. And then also on Wednesday, you had core inflation month over month rose 0.3%, and year over year it's at 3.3%. That's core inflation. The regular inflation rate month over month was up 0.2%, and year over year 2.6%. So basically, inflation is kind of, they call it sticky. It's not coming down a lot. And you can kind of see that more from the 30-year mortgage rate, right? When inflation is going up, the rate tends to go up. And even though the Fed is cutting rates, but again, we keep saying the Fed cutting rates is sort of a misnomer. The only rate the Fed is cutting is what's called the Fed funds rate, and it's just the rate that banks lend to each other on an overnight basis. So it affects the 2-year bonds and less. But the bond market affects the 10-year, 20-year, 30-year bond. Thursday, initial jobless claims, 217,000 versus 225,000 that was forecast, and 221,000 last week. I think it's a weekly. So definitely less jobless claims. That's good. PPI is the producer side of inflation. That was up 0.2 versus 0.1 last time. So inflation on both the consumer side and the producer side is ticking up a little bit. S&P was down 0.6, and then Friday, not great for the market for sure, at least so far on Friday. Retail sales were up 0.4 last month versus a revised 0.8 higher. So the revision is actually the thing that everybody was talking about on Bloomberg. Retail sales are definitely getting better, and you can kind of see it well, it's not really related, but New York State Manufacturing Index was also up a lot, right? 31.2 versus 11.9 last month. So the economy is definitely getting stronger. But again, as of 10:15 on Friday morning, S&P is down about 1%. But the New York Manufacturing Index, like this is a big deal. If it doesn't get revised down, and especially if we get another higher print next month, manufacturing is definitely, it's getting better. It's been improving, right? So if it continues, the economy is getting better. It's getting stronger. This is the manufacturing side, which is good. Okay, so this is the post that's got a lot of people talking, and they should be talking about it because it's pretty important. And a lot of people kind of roll their eyes about this, but it's worth reading and having in the back of your mind. 0% return for the C fund over the next 10 years. So imagine kind of like the top in 2000 to the top in 2013. Not the top, but to where the market gets back in 2013. That's 13 years. I can't remember the number. I can't remember the number, but whatever the top was in 2000, there was a 50% decline into 2023. The market recovers all the way back to 2007, then a 55% decline into 2009, and then it took until 2013 to get back to even. That's a 0% return for the C fund over 13 years. Okay, so that's an example of what this is. So what this article is about is, can we have a 0% return for the C fund over the next 10 years? Okay, how would we figure that out? So this is pieces of the article. Okay, so the underlying index for the C fund is the S&P 500, right? We know that the C fund tracks the S&P 500. So the question is the S&P 500 currently overvalued? And if so, what does that mean for the C fund performance going forward? So Robert Shiller, if you've never heard of him, he's a great guy to follow, Nobel laureate. And what he did was he created this thing called the cyclically adjusted price to earnings ratio. Sounds very complicated, but it's not really that complicated. It's a way of kind of projecting returns going forward over 10 years. Okay, so what he does is you have the price of the S&P 500 index, right? So this is all about the S&P. So you take the price of the S&P 500 index and you divide it by the earnings averaged over a 10-year period. Okay, so you get the price of the S&P 500 and you divide it by the average of all the earnings for all the companies in the S&P 500 over a 10-year period. And earnings is just the net profit, right? So whatever a company takes in minus their expenses is their earnings, okay? So if your earnings stay the same, let's say, year over year, but your price keeps going higher, earnings are supposed to be the thing that supports price movement. So if your earnings are staying the same, but the price of your stock is going up, that's an indication that the price is being overvalued, right? Because the earnings are supposed to support that price. So what you want is price to go up and earnings to go up. If earnings come down and price goes up, then the ratio really goes up, okay? So it's saying here, as of this writing, this was like a week ago or so, Shiller PE is at 35.5, okay? So this is a chart, long-term, right, going back to 1880. So it's a long-term chart. And it's within the last couple of days. So the CAPE ratio has actually gone up to 38.25. So the important things here, like we said, right, when price goes up and earnings go up, the ratio would stay the same. If price goes up faster than earnings, then the trend of this line is up. Okay, so the higher this line gets, the more extended price is away from the supporting earnings level. That's like the best way to look at it. If the higher this line goes, the more overvalued the company is in price relative to its earnings. Okay, and earnings is the thing that's supposed to be able to support price movement. So, okay. So you'll notice there were historical relative peaks, right? In other words, there are times when the Shiller PE rose, peaked, and then fell. These peaks, relative peaks occurred in 1902, 1929, 1937, 1965, 2000, and maybe 2021. So these are the peaks, right? Basically, he's saying higher highs, right? These are the peaks. And when you have a peak, that's fine. Price is going up relative to earnings when the line is going up, and everybody likes that. But when it rolls over, that's when bad things tend to happen, right? So what happens after these peaks? Unfortunately, the picture is not pretty. You may have noticed that stock prices were close to flat or sharply lower for 10 years or longer after each of these relative peaks. Okay, so what does that mean? I couldn't overlay the two charts, but let's say 1900 to 1920. Okay, stock prices, because this is the S&P 500. Okay, and this is where we were, right, a couple days ago at about 6,000. So this is the logarithmic chart of the S&P 500. And so from 1900 to 1920, we had a 20-year flat period in the S&P. Okay, we also had it from like 1965 to 1982, basically flat. Now, I say flat, this was a 50% decline in stock price. Okay, but from this high to this high, it was a flat. Okay, so that corresponded to 1900, right, to 1920. So when the Case-Shiller PE chart line is going down, stock prices are under a lot of pressure. Okay, in this case, it was 20 years of the index of the ratio going down, and stock price is flat. Obviously, if the line tanks like this, the market is tanking. Okay, this is the Great Depression, right? This is 29 to 30, whatever, market's tanked. This is 2000 to 2003, and this is 2007 to 2009. Okay, so it's kind of obvious when the line is tanking that the market is crashing. But what we're talking about in this article is these long periods, right, where the line's going down over a long period of time. And when you get that is when you get these 10, 20-year periods of flat. Okay? So if the CAPE index is predicting that the S&P will return 5% per year over the next 10 years, 95% of the time, the actual 10-year falls between 2.26 and 7.74. So basically, 95% of the time, which is basically all the time, you're in the middle. You know, if the prediction is 5%, you're in the middle between 2.5 and 7.5, right? So it's close. So the predictions that they make based on the Shiller index is pretty good. So here he's saying, do you remember that what the CAPE is at the time of this writing is 35.5. Now it's whatever, higher than that. As you can see, it's off the charts. With the CAPE at 34, the predicted 10-year return is between 1.9 and 3.8%. Okay? With a CAPE of 35.5, it would have been predicted even lower returns. So we are actually at 38.25. The average is something like 15. If you look through there, because it pretty much oscillates along that line, or at least it did until here. There are some people that are saying that the index isn't really valuable anymore because at the bottom in 2009, it only got back to the mean. It only got back to 15. It didn't get back down here to like 10. But being up here at these levels is telling you that the S&P 500 is extremely overvalued relative to the earnings that are supposed to support it. That's the bottom line. And if this trend line gets violated down here, this is really bad for stock prices. Now, if the line got back down here, it would be great it would be a great buying opportunity, right?
But you have to be out to buy.
Right. For our purposes, you have to be out.
Yeah, if you ride that down, you're not buying anything really in the TSP.
Right. And the thing is, like most people, right, they like it when the market's going up and at all-time highs and high exuberance and all that, and they're very bearish when it's at the bottom. So that was the point of this piece, right? Business Week publishes the now infamous article, "The Death of Equities," and you can get it if you go to this link. It's worth reading. That article is called "The Death of Equities" because usually when people write things like that, that's the bottom, right? And so when that article came out at the end of the last decade in the 70s, the Shiller index was 10, right? So and then the following years widely regarded as the greatest bull market ever. When this was here, right? Or here, wherever, it was at 10, right? When the line gets down here to 10, can the market continue to go lower? Yes, but you're getting close to being undervalued, right? And that's when you want to actually buy things, when the market is undervalued, not overvalued. So the potential to make a lot of money where we are right here is much relatively less than it would be if we were down here somewhere. That's the point. It doesn't mean you should sell everything, because this can keep going higher. It just means it's an education piece. We are historically way overvalued in terms of the price of the S&P 500. And at some point, it's going to roll over.
And if you're a diehard buy and holder, you're going to get stung pretty hard.
Right. That's the overarching message of this whole thing. If your mentality is, nah, screw it, CNS and ride or die, you're gonna die from it eventually.
Yeah, it has to happen. It's happened in the past. It's going to happen again. We just don't know when. So if you're not paying attention to it, you're going to get bit.
Just know that it's out there. That's all. That's all we're saying. Yeah. Okay. Investor exuberance. So if we sort of switch to from a long-term perspective of it back to a kind of a shorter term, this is the fear and greed index as of Thursday's close, and it's going to be lower. The number's going to be lower at the close of the week on Friday, because Friday looks like it's going to be a down day. So what does that mean? We are nowhere near at extreme greed. We're going to be probably in the neutral by the close on Friday, which means there's plenty of short-term fear out there to drive the market higher once we get to some kind of short-term support level here. If you remember, a month ago we were at extreme greed, and then we had 2 weeks in October of a little bit of a pullback right before the election, and then the market explodes to the upside for that week. So in the very short term, right, there is definitely room once price stabilizes out here for the market to go higher. And this, if you're not following Lance Roberts at realinvestmentadvice.com, you should definitely get on his mailing list. His newsletters are really, really thorough and comprehensive. And this was a good one. Consumer confidence, right, in stock prices over the next 12 months. Everybody thinks that stock prices are going to go higher over the next 12 months. Generally, when everybody thinks prices are going higher, they generally don't. This was the bottom in 2022, right? Nobody was confident that stock prices were going to go higher, and that was the bottom. That's generally what happens, right? You could do this for all these. I mean, there's the bottom in 2009. It's when everybody thinks the market's going to keep going higher. Can it continue to go higher for some amount of time? Yes, right? None of these things are actionable. It's all perspective. We are closer to a top than we are to a bottom, put it that way. Okay. All right. And this, I think, the 10-year yield, we talk about it all the time, but honestly, it's one of the most important charts going, because the 10-year yield controls, I mean, mortgage rates are 30-year, but the 10-year yield controls basically mortgage rates, credit cards, car loans, companies' ability to borrow, small companies, not so much, Amazon, who doesn't need to borrow any money anyway, but if you are a small to medium-sized company, the loans that you get from the bank are based on the 10-year yield. So 10-year yield peaked in 1981, and we had a 40-year decline into 2021, and then the Fed started raising rates at the same. So bond yields started going higher, right? So we had a bottom in bond yields, in the 10-year yield, and then it started going higher. So at some point, either we have hit a 40-year bottom, this is the final bottom, and we're going to get some kind of, this is what we had here. We had 40 years on the upside. This only goes back to 1963, but if you looked at a chart going back further, it goes back 40 years, which is kind of odd. But it goes back 40 years from here to here. Then it's 40 years from here to here. So is it unreasonable to expect that we're in an environment of rising interest rates for the next 40 years? Doesn't mean we're going to get it, but it has to be on the table, right? Even if it's not, this little uptick did not retrace enough of that down move, right? It just didn't. But it was a big move in terms of percentages, right? Because we went from 0.5% to 5%. It was a huge percentage move, but it definitely didn't retrace all of this, okay? So we have the first uptick. It was a big move up. And this move down, this little move down we've had here, that wasn't enough to retrace all of this move. Okay, so if we go to a shorter time period, all we're looking here is zooming into this part, okay? Because this is the only part that's really important for us. This is the bottom in 2020, right? Rates are at 0.5%. They move higher in a 1, 2, 3, 4, 5 Elliott wave pattern to give us a 1. Then we should expect some kind of correction to a wave 2. And once we get there, this, in my opinion, is going to be the lowest that rates are going to be in our lifetime. So whenever we get there, whenever that low is, this little move that we've had down, this little correction, is not enough to correct this whole move. So if this is all we get in the correction of that, and this keeps going higher, this is going to all end up being one big one. It's going to just keep going. Rates are just going to keep going higher, which has all kinds of, not good implications for the economy, for those of us that, live, I don't want to say live paycheck to paycheck, but, your spending power goes down a lot as interest rates keep going higher. So what I'm really looking at right now, in terms of this, that ABC, that can't be the whole correction. So what are the other possibilities? One, how did I want to say this? 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5, something like that in terms of Elliott wave. If we get above this level, right? If yield gets back up here to like 4.6% and takes out this high, then there's a good chance that it just keeps going. So it's close to being pretty important. I mean, I really, if yield comes down like that, it's probably because the stock market is crashing. So nobody really wants that, but yield has to come down for the economy to get back to normal. It's the most important chart to be watching right now, I really think. Okay, TSP fund charts. So this is as of Thursday's close, so it's going to be a little bit worse looking than how it is on this chart. But we had a huge up week last week, and in the big scheme of things, even if it finishes down here, at 92.5, it'll be a big down week. But all it's doing is retracing the big move that we had last week. So if you're looking at, stocks on a weekly basis, this is the 20-week moving average line. We got a long way to go to come down to test support at that line. But the trend obviously is up. Is relative strength rolling over here? It doesn't look like it, the divergence that we had seems to be resolving to the upside, but it's not really clear one way or the other. It's going to be high volatility going forward. And so as on a weekly basis, as long as we're above this 20-week moving average line, the trend is up. This is a little bit of a head fake right here because intra-week we dipped down below the 20-week, but at the close, it closed up here at the top of the week's trading range. So we haven't been below the 20-week moving average since back here in 2023. So it's if we do get down here, it'll be significant because it'll be the first time we've been below that moving average line in over a year. But we're definitely not there yet. So if you're looking at it on a weekly basis, the trend is definitely up. S Fund, monster breakout last week. And again, we're getting a pullback from that, which should be expected, But there's nothing here to indicate yet. I mean, the long-term trend obviously hasn't rolled over. Not to say it won't. Plenty of headwinds going forward. We got above the prior high, which is good, right? Could it pull back to anywhere in here and then keep going higher? Absolutely. And no one's going to want to like the way that looks on their TSP account, but if you look at it on a chart and take it in perspective, it can pull back quite a bit and still be in this long-term uptrend. iFund is a problem. Generally, we're at the bottom here in 2022, right? So the iFund has been moving higher since the bottom in 2022. The S Fund has also been moving higher since the bottom of 2022, right? The C Fund has been moving higher since the bottom of 2022. The problem is, right now, the iFund, at least on the short term, has been declining. And we had a huge down week this week. Okay, we broke down through that 50 RSI line. So we absolutely have a sell trigger on a weekly basis on the iFund. So it peaked back in late September. The C Fund kept going higher. As the iFund was falling, the C Fund was continuing higher, right? That's divergence. If they're all generally moving in the same direction, but then you get a period of divergence, either the iFund, if it keeps going lower, is going to pull the CNS down with it, or the iFund's going to turn around and start rallying with the CNS funds, right? So that divergence is something to watch. The lower the iFund goes, the more likely it pulls the other two down with it. So that's a big, not really a head scratcher, because it's pretty clear what's happening. The divergence is not good. And then the F Fund, again, as 10-year yield continues to go higher, the F Fund continues to go lower. Are we at a support level, kind of like we were back there in April, and we find support and we keep moving higher, which means yield comes down? It's possible. We're just not there yet. And the G Fund, as we know, keeps moving up and to the right, which is great. But it's not great relative to the stock funds when the stock funds are going up. Okay.
Questions. If you have questions, you can put them in the comment section wherever you find the video. If you don't see a comment section, you can email us. support@growmytsp.com. Hope you guys are having a good weekend. Just stay along for the ride. Check the show every week, and we'll try to keep you informed on what's going on. Hope you guys have a good rest of the weekend and a good week.
Out of here.
We'll see ya.